Hi, there's a couple of topics I want to go through this week. The first one, we have 3 central bank meetings. Front and centre is the Fed Reserve, with Walsh offering no forward guidance. And the second of all, I want to look at equities. Mounting headwinds, where are we going from here? Hi, welcome to another Super Macro podcast. My name is Elvis. Sitting opposite me, as per normal, is Jonny Matthews, ex-hedge fund manager and the writer of the Super Macro Note. Hi, Jonny.
Hi, Elvis. How are you?
Yeah, I'm good. Jonny, look, we've got some charts to go through and lots of things to discuss. Where do you want to start?
Well, let's start with the central bank meetings this week.
Okay.
So,
Most important one being the Fed. Right?
Yeah, absolutely. So, I think, obviously, there's an increasing risk that they hike this week, and in fact, and I'll show you in a minute with the chart that the market is now pricing about a 1 in 3 chance of a hike. And we've had a couple of Fed speakers prior to the blackout period. We had Laurie Logan of the Dallas Fed, Beth Hammock, Cleveland Fed, both of them saying that
they're voters, are they?
They are, yeah, of course. There's no point listening to the non-voters, to be honest with you. It's really just the regional Fed presidents that have a vote. They're the ones worth listening to. Those two said something along the lines that if you're going to hike, it's better to hike early and get it out the way. You probably won't have to hike as much as if you leave it until later and then you're hiking in a rush.
But this is not going to be Walsh's MO, though, is it? He's clearly going to be on the other side of that, i.e. maybe bailed out slightly by the fact that Trump at the weekend decided not to go through with the tax, crew came off, etc.
Yes, I think there's 3 things. First of all, you're right, crude prices have dropped back 5 or 6% today. Secondly, we had a very, very benign CPI print in June, if you remember.
Yeah.
Core inflation down to 2.6 from 2.9%. Headline, I think, to 3.5 from 4.2, if I remember correctly. So both those prints were below expectations.
Yeah.
And I think the next Fed meeting is in September, and by then there'll be 2 more CPI prints and 2 more payroll reports.
Right.
So I think, for a data-dependent Fed, it kind of makes sense to perhaps wait until September before deciding.
Yeah, that's what I would go with on this. I can't see them getting through a rate high on votes alone.
No, I just don't think so.
This time around. I
don't think so.
The smart thing is, even if you want to raise rates, maybe stick now and do it next. When's the next one? September 15th, 16th. Yeah.
But the market, August Fed funds futures are trading at something like 96.28, which implies, the implied rate is 3.72%. Now, just to explain what that is, if we bring up chart 1, okay. The Fed has an upper and lower band for their target rate. Lower band is 3.5, the upper band is 3.75, and Fed funds currently trade roughly in the middle of that band, 3.63%. August Fed funds futures imply a rate
8.5 bips higher.
8.5 bips higher than that.
Right.
So let's put it this way: if they don't hike, the average effective Fed funds rate during August will be 3.63, back in the middle of that range.
So how do you get to the 1 in 3 chance of a rate hike?
Well, if you look at, let's put it this way: if they don't hike, the average effective funds rate will be 3.63 during August. There'll be no change. It'll trade in the middle of the Fed's target band. If they do hike, it'll trade 25 bits higher than that.
Risking 8 to make 25, or the other way round is taking 8 to lose 25. Yeah.
Now, I think that's fair. If you think that they won't hike, you can buy the August Fed funds futures, and if you're right, you make 8.5 basis points. If you're wrong, you're going to lose 16 or 17 basis points.
So it's 2 to 1 shot.
2 to 1 shot. Yeah. So for me, even though I don't think they're going to hike, I don't like that.
You done the
I don't think so. I don't think so.
Okay, all right.
I think if it was more of a 50-50, if it was priced as a 50-50.
Yeah, then it may. But I really find it I would find it very interesting if they managed to hike. I really would, bearing in mind the stance of the Fed chairman,
Yeah.
who's shown us his real colours, ignoring the first meeting they had it since then.
But I think 1 in 3 is probably fair odds. So that's as far as the Fed is concerned this week. But the following day we've got the Bank of England, and I think there is almost no chance of them hiking at this meeting. I think there's a good chance they don't even hike for the rest of this year.
What's the market pricing?
Oh, it's only pricing about a basis point in for this meeting.
For the whole year.
For the whole year, well, actually, there are more hikes priced by the Bank of England than by the Fed. I
know what you think about that.
Yeah, I think it's not going to happen
enough times. Yeah.
Yeah. So I think there's something like 3 hikes priced by the Bank of England by this time next year.
Wow.
Yeah. And if you look at, if we bring up chart 2, I mean, this is really my concern. Really, is that the labour market is incredibly weak, and this is the monthly change in payrolled employees. So this doesn't count self-employed. It's really just employees who are paying through some kind of pay-as-you-earn scheme. This is from HMRC tax records.
Right.
So since the October 24 government decision to hike the payroll tax.
The red lines are starting getting bigger.
Employers' national insurance contributions. So that payroll tax went from, I think, 13.8% to 15%. 1.2 percentage points doesn't sound like a lot, but as a percentage of the amount of tax that you're paying, 1.2 points on 13.8, it's about an 8% uplift to the tax.
What about sorry to interrupt you, was the minimum lending wage at the same
minimum
time?
Wage.
Minimum lending wage. What am I talking about? Minimum wage. Did that go up at the same time?
Minimum wage in the last 2 years has gone up about, I think,
15 quid an hour.
30% in the last 2 years.
£15 an hour?
I'm not sure. Not sure.
Guess. That's a guess.
Yeah. So the point is, these are both quite significant headwinds to employing young people.
Yeah.
And if we look at the next chart 3, and this
is horrid.
I'm amazed that there isn't more of an outcry over this. But if you look at youth unemployment in this country, certainly 16 to 24-year-olds there, you can see it. It's now at a 12-year high, 16.4%. I think the most recent.
This reminds me of the 1970s. Probably very similar action there as well. I know youth unemployment was extremely high then.
Bit before my time, Elf.
I don't think so. Anyway.
But overall unemployment's come down slightly. But the figures, the reliability of this survey is not 100% accurate. The ONS is trying to improve the reliability. But the bottom line is, if you look at the trajectory of unemployment, both youth unemployment and overall unemployment in the UK, it's kind of going one way. It's heading higher. We don't see that in the US. And I think for the Bank of England to hike rates, what does it achieve, really? It's going to make the matters worse. I don't think they're going to be able to drive inflation down by doing that.
Surely the government sees this data. They get the same raw data you can get.
Oh, yeah, it's not down to the government. It's down to the Bank of England, whether they hike or not.
No, but the original policies that started to cause the youth unemployment to go higher and not curtail and not bring unemployment down were because of these policies that she brought out. Surely,
former Chancellor
she
Reeves
must be getting told. She must have been getting told, and Burnham's probably been told the same thing.
Yeah, by businesses how counterproductive
what are
this
you
was.
doing? I'm not employing people because you've done this, and this.
Without a doubt, but it is what it is, and
they can give out more. They can give out more benefits. I forgot.
Well, let's not get too political.
Sorry about that.
And then, of course, at the end of the week, we've got the Bank of Japan.
Oh, right. Yes, this is interesting.
What they're trying to do at the moment, they're trying to control too many things. We've discussed this previously.
Yeah, a few times.
The government, the administration is handing out subsidies for
stimmies all over the place.
Well, they're not exactly stimmies. They're subsidies for household energy consumption.
That's not stimulus, isn't it?
Well, you're right. It is stimulus. It is a fiscal stimulus at a time of rising inflation. But as a result of the cap on fuel price, the subsidies to energy. Inflation, headline inflation, has been suppressed.
It's artificially low.
It's artificially suppressed. So they're handing out these subsidies, suppressing the rate of inflation, meanwhile adding to the fiscal deficit. And as a result, both the bond market and the currency are taking it, both of them, taking it on the chin.
It's a self-fulfilling prophecy. The more that they do this, the more the currency goes weaker, the more they import inflation, the more the currency goes weaker.
100%. You hit the nail on the head. I don't have the chart for that, but import prices in yen terms are going through the roof because you've got the increase in energy costs, and Japan imports most of its energy, and that is compounded by the weak yen. So in yen terms, what they're paying for a price per barrel of oil is going through the roof.
So how long can they go on with this for? Because it doesn't make sense, because the policies are counterproductive. One's the opposite of the other one.
Absolutely.
And how does this? First of all, how long does it go on? Can it go on for? And how does it end?
Well, it's a good question, but you've got to look back through history. You know, Japan had a lost decade. It was a lost 2 decades.
2 decades.
Abe came in.
When they were desperate for inflation.
Yep, that's right. Trying to get nominal GDP growth off the ground, and trying to get inflation out of the danger zone where there were, where from time to time it was heading into deflation.
Yeah.
Needed to get away from that. The current Prime Minister, Takaishi, was a student of Abe's, and she's, taken his ideas and really run with them and turbocharged them, if you like. And the idea is to get nominal GDP growing a lot faster, and perhaps
That's reflate your way out of the problem you've got.
Yep, perhaps reflate their way out of the debt burden. But I think they're trying to control too many things at once. And if we bring up chart 3?
Oh yes,
the worst performing sovereign bond market, or advanced economy sovereign bond market this year is the JGBs. I mean, the 10-year is up something like 170, 175 basis points.
That's an enormous move.
This year it is an enormous move. And when you look at the chart, it kind of looks like it's going vertical. It's not quite that bad, and it's either the, Katayama, the finance minister, is trying to, talk down these bond yields any way she can.
Anybody we want to invest, Japanese to invest in Japanese assets, etc. Blah blah.
Yeah, and at the same time trying to talk up the currency.
So they don't want to reform the system that they've got. They just basically want to tinker with it to stop from getting any worse.
Well, the bottom line is they don't want the BOJ to hike. That's it. It's as simple as that. They'd rather the BOJ keeps rates low, with the idea that ultimately, because the government has to pay the funding costs, and they'd rather not see interest rates going higher.
So, Johnny, does this suit the Bank of Japan? Because they're funding their bond portfolio at 1%.
Yeah, I guess they are funding at the overnight rate, and they have a big portfolio of bonds that they own that are now, as they continue buying, keeping the quantity constant, but the new bonds that are being issued, they're gathering them up
at much higher rates.
Yep. But the opposite side of that, the government is paying more and more by issuing these new bonds with a coupon of 2.8%. So it is ultimately unsustainable the way things are going.
So, okay, I've asked this before. I know we've had this discussion numerous times. What breaks first, the JGBs or the currency?
That's a good question. My money would be on the currency, but the problem is it's a very, very difficult game to play, because you can hold dollar yen and you're earning positive carry. The US rates are substantially higher than the Japanese.
It's been a profitable trade.
Yeah, absolutely. The carry trade's been a great trade. But once in a while, they will do some actual intervention and knock you back 2 or 3 big figures.
For about 20 seconds, and it goes straight back up again. Sorry,
yeah, but you never know. They may get serious about it.
Yeah, they might do an extra large bit to really mess people up out of their positions.
And then, when it comes to JGBs, they're thin and illiquid compared to treasuries, and it's called the widowmaker trade for good reason.
Been short of them, but not recently. It's been a
good trade.
Should we move on to equities?
Yeah, let's discuss equities.
Now as I said in the opening, there's been the headwinds are mounting, but let's just talk about the S&P just for the moment. It doesn't seem to care.
It is beginning to care, I think.
Oh,
it is
okay.
beginning to care. I mean, we're
only about
quarter.
what were we off? 1.5% from the all-time high, something like that.
Something like that.
Something like that.
Yeah,
That doesn't seem
not much.
That's not caring very much, I don't think.
That's one way of looking at it. The other way you could look at it is that it's gone. Really, the index has gone nowhere for the last 2 or 3 months, and there's an increasing amount of turbulence beneath the surface.
You've talked about this on numerous occasions.
Volatility of the single stocks has really picked up, and the results that are coming through. I mean, they're so far we've had, I think, 133 companies out of the S&P 500 have reported. Earnings per share growth is on track for something ridiculous, 38% year on year.
It's unbelievable, isn't it?
But heavily distorted by, Alphabet. I've got the numbers here. Alphabet reported earnings per share of over $9.
Up from what?
Well, the estimate was $291.
Sorry?
Yeah. But that included $98 billion
right up in the
unrealized equity gains on their stakes in Anthropic and SpaceX. Just written those up. If you strip out those, the earnings per share was actually below the estimate. Below the street estimate.
Okay, because the share price came off afterwards.
Yes, and I believe if you normalize Alphabet's earnings on that basis, then the S&P 500 EPS growth is running at about 25%.
Still decent.
Still decent.
Decent, yeah.
The same kind of pace as it was in Q1.
Because you've mentioned this before numerous times. I know that we discussed it in the note. You've discussed it in the note and on this show. That the price or the multiple the S&P trades off is probably justified with the earnings growth that we've seen.
Yeah, assuming that. But that assumes that earnings growth will continue.
Yeah, okay.
And I think there are mounting headwinds from not only the massive capital expenditures and doubts over whether those that capex will create
the ROI.
The return on investment that the companies are expecting. And the problem is there are increasing demands on investors' capital, both in the private sector and in the public sector. Obviously, the US government's running a deficit of 5 to 6%. The private sector, certainly these hyperscalers, are issuing more and more debt to fund their expansion. Some are issuing equity. I mean, we had, I think it was Alphabet, wasn't it, recently raised 75, 85 billion.
80 billion. Eight was a figure.
Something like that.
Big figure somewhere in there.
Yep. And then you've got other, I think Meta may be coming to the market.
So as free cash flow goes down, they're going to the bond markets to raise the cash.
Yeah.
Well, why aren't they raising it via equity? Because their equity prices are so frigging high. Surely that's a way to raise money, no?
Well, what they are, indirectly they are. They've curtailed the stock buybacks.
Oh, I see.
So
right.
in a way they are.
In a way it's the same thing.
It's kind of the same thing. And if we look at, I don't know if I've shown this before, chart 5, the free cash flow of these hyperscalers is going to go close to zero from 250 billion a year. It's dropping down very, very fast. It is negative with at Oracle and Amazon. Amazon, the big companies like Amazon and Alphabet, Meta, you don't really have to worry. This is going to be a temporary phenomenon. They've got enormous revenues.
They'll spend, then they'll keep on earning, and then free cash flow goes high. Yeah.
But obviously, Oracle, you can see it's deeply negative, and people are kind of questioning how long this is going to last for.
We talked about you've got the hyperscalers free cash flow there, but there's another headwind building up, isn't there? What the Chinese are producing in terms of their own models, which seem to be a lot cheaper to run. And less chip intensive.
I think it is a new competitive threat. Yeah, my understanding is these models require less processing power, but maybe more memory. So
right.
But even so, they are lower cost, and they're open weight models, which means I think people that know what they're doing can tinker with the. Can download the software and make modifications themselves. It's a bit beyond my tech pay grade.
A lot more than mine.
But even so, these new entrants are coming into a marketplace where the hyperscalers and the developers of large language models are spending absolute fortunes to create a product, to create leading products and become really the dominant player in that market. When you have all these other players coming in, chipping away, and lower cost models chipping away.
But that's ultimately what matters. I know we discussed this last week, and we talked about, at the end of the day, it's not necessarily the people who invent the software or invent what you use. It's the people who use that invention who get the benefit.
Well, I think the interesting thing is now the market is becoming more hostile to when the companies report, even if they report an earnings per share beat, but if the capex expenditures are going up by more than the market had anticipated, that's what the market is really focused on at the moment. And as a result of that, some of these large cap companies reporting during this earnings season so far, even though they've delivered earnings per share beats, the share price has reacted negatively.
Yeah. Okay.
And I think that's a significant.
That's the
headwind.
focus now, isn't it? On the earnings that we're seeing at the moment.
But the way I see things now, I mean, when I say it's a headwind, I think the market could have a small setback of a few percentage points.
The S&P we're talking about here.
We're talking about the S&P, or and other really global stock markets could have a bit of a setback through this period. I don't think it's going to be a massive setback, and I don't think. I sometimes listen to podcasts where people are worried about leverage in the system, these leveraged ETFs and so on. This is not really household leverage. Households have deleveraged themselves at the expense of governments. Governments have piled on the leverage since the financial crisis. The household, the private sector, has deleveraged, if anything. And I think, these leveraged ETFs, you spend $1,000 on a leveraged ETF, the worst case is it goes to zero. Yep, it's not like a leveraged bet on like buying a futures contract or something like that. It's kind of like buying a call option. So
not a very good call option at times.
Well, no, I mean, look, it is similar in that if the underlying just doesn't go anywhere.
The underlying keeps on going like that, then the leverage ETF
then it's
works
great.
As soon as it does this or turns, that leverage ETF craters.
Well, with the leveraged ETFs, if it just spends time in a range chopping around,
that's a loss.
There's a lot of hedging costs, and you find the value of the ETF will decline.
We discussed this short. It's very short, a one-day gap.
I don't really think it's a systemic risk to the market. So, but what I do feel is that we're in an environment now, and I've discussed this previously, we're in a higher nominal growth environment, which will require greater demand on capital, on investors' capital.
Cost you more.
As a result, the price of that is going to go up, whether it's the government borrowing or whether it's the private sector that's doing the borrowing. You're going to have to pay more in terms of interest rates. So the era of low interest rates, low and stable inflation, that ended with the pandemic. We now have frequent supply shocks.
That was the anomaly.
Yeah, that was the anomaly. That period ended.
What we've got now.
Not what we've got now. And I think, when I look at very long-term bond yields, if you bring up chart 6, investors, all of us actually suffer from anchoring biases. Our expectations are anchored by our previous experiences. We all have it. I'm aware of my own biases, which I have to take account of in my trading. It's very difficult, but I think many investors are anchored by the experience, the post-GFC experience, where bond yields were low, interest rates were low, inflation was low, and that period is over. And when you look at it from a long-term perspective,
we're going back up to where we were.
We are going back into that environment, of deglobalized, a deglobalized workforce, deglobalized product supply chains, more volatile and higher inflation, and increasing risks of lending long-term.
So let me get this right. What you've discussed today so far. You think that the bond markets still have a problem, and you're probably short of bonds, or want to be short of bonds as your position. You believe that the equity market could go through a bumpy ride, but nothing too serious. But you're cognizant of the fact that it could drop a few percent, 3, 4, 5% maybe.
Yeah. I would scale, if I had big, long positions in equities, I would want to scale them back. For me, I have my personal portfolio, which is just tucked away, don't really look at it. And then from a trading perspective, I'm short the market with options. I'm expecting some kind of pullback.
So you can keep so in other words, if you had a long beta portfolio of long stocks, you could hedge that quite efficiently with S&P vol, which isn't expensive yet, based upon the fact that the surface is calmer than the underneath.
Yeah, that's quite correct. And I think it does make sense to hedge portfolios now, the way things are, through the summer with options, because implied volatility, as you rightly say, is kind of towards the lower end of its range, certainly for the index.
Yeah.
So yeah, that's the way I'm playing it. And I was asked a question recently. Well, what will happen? Supposing the Fed does hike, what will happen to the long end of the Treasury market?
Yeah.
Will it sell off, or will it rally? In other words, will the long end rates go higher, or will they go lower? I'm not a great believer that if the Fed hikes now, then the market will say, okay, they've hiked. That means they're going to fix inflation. We can start extending duration, piling into long dated bonds.
You think that'd be a mistake?
I think it would be a mistake to look at it that way.
That's not investment advice.
No.
This is just your view.
Just my opinion, because I think for the holders of the typical investors or traders of treasuries, you're looking at a number of things. You're looking at the carry, which is effectively the difference between the 10-year yield, which is 465 or whatever it is, and the overnight rate's 363. So you've got about 100 basis points of carry.
Yeah, right.
You got the roll down. It's a small thing. Eventually a 10-year bond becomes a 9-year bond, which yields a bit less than the 10-year. Yeah. So, the yield drops, the price goes up. So you've got carry and roll down in your favor. If they hike, you have much less carry and a flatter yield curve, less roll down. It's less attractive.
So you think that the 10-year yield could go higher again?
I think it could. And not only that, if the Fed does hike, I think investors will start looking at, when's the next hike? Until the market can see a realistic sign that, they've reached the peak. Inflation has peaked, the Fed's finished hiking. Until you get to that point, I'm not sure people will be so keen to extend duration.
Right, I understand. Okay, Jonny. Well, thank you for this. Could you just let everybody know if they want to read in more detail what you're thinking and where they can get hold of you?
Absolutely. We just scratched the surface here.
They can send you a birthday card as well, can't they?
Let's not get into that. Thank you, Elvis.
Where can they?
Unless you didn't have a go at the tooth.
Yeah, okay. We're not going to have a go at the tooth. We'll do that a bit later.
So
where can they reach you?
super-macro.com. You can sign up for a subscription to my daily newsletter. I discuss each day the day's main macro events, what the implications are for the market, and then once a week I do a run through the major economic regions and a deep dive into markets and what my thoughts are. Now,
and why do you write the note?
It's primarily to help me. Yeah. I find that when I write stuff down, it really clarifies my thoughts. It forces me to do the research needed to be able to come to some sensible investment conclusions.
Okay, thank you.